Hello, I'm David Frazier, the President and Chief Market Strategist of Frazier and Mayer Research, LLC, as well as InvestorsMonitor.com, and of course, the editor of our investment research and advisory journals, specifically for this service for individuals, Frazier Strategic Allocator. Well, we're recording this week's video on Tuesday afternoon, April the 4th, and several what I think you'll find to be several interesting topics, or should I say interesting and helpful information. So let's get right into it. Okay, first of all, well, I hope some of you at least followed my recommendations to buy Restoration Hardware, which was recently renamed by the company RH, symbols RH, and Sears Holdings, SHLD. Let's see, well, I put that aside. I don't recall exactly when I recommended Restoration Hardware. I think it's been a few months ago, but Sears was only in late February. And if you did follow my buy and sell recommendations on those stocks, you made some good returns in a really short period of time. Let's see, I'm showing that if you bought both of these stocks when I advised our subscribers and clients to buy them, and sold them when I advised our clients and subscribers to sell them, you would have made approximately a 32% return on Restoration Hardware and a 45% return on Sears Holdings. On Sears Holdings, wow, less than about 6 weeks on that stock, and Restoration Hardware, it was a few months I think we held it. Now, okay, that's great, that's wonderful. I'm happy about that, and if you bought and sold those securities, I'm sure you're happy about it too. But what I always, I don't like to just talk about or mention or focus on our winners. It's easy in anything in life to focus on your winners and to talk about your winners, successes. But I pay just as much attention to failures and to reevaluating and to monitoring or trying to end future failures. And I'm bringing this up primarily to say, okay, well, we had some great gains in a short period of time, at least good gains given the period of time, on Sears and Restoration Hardware. But, well, we're down approximately 35% in our short recommendation on Tesla. And I'm remain confident that we're going to make money on Tesla. I mean, at one point, I think we were down 23%, might have been 28%. It was definitely over 20% that we were down in Restoration Hardware, and still we made a 32% profit on that stock. And I'm still confident that we're going to make money on Tesla. But, there comes a point, and once again, like anything in life, that regardless of what one believes or thinks, you gotta monitor and manage your risk. And the fact of the matter is Tesla's down 35% as of today from the time that I recommended selling it short back during late October of last year. And the momentum is against us right now. I mean, we've got a herd of people coming towards us. One person here. If you're the person holding this stock, you've got a herd of people coming towards you. Now, you might know that there's a cliff behind you. In other words, if you just lie down, those people keep coming towards you, they're all going to die if they fall off that cliff. But there comes a point you need to get out of the way. And, whether it's lying down or running in a different direction, and, I'm obviously using an analogy here, but that's what we have regarding Tesla. We've got this herd of believers that they're going to make a ton of money in this stock. And, some of those people have made a lot of money in the stock over the past few years. But, so what I'm saying to you is two things. One is, look, Tesla came out 2 days ago, well, not 2 days ago, yesterday, and on Monday, and they made an announcement regarding their sales, they call them deliveries, of their automobiles over the past few months. And the number of sales of deliveries were more than, quote, analyst expectations. Oh, wow, like that's just, I don't want to get into that stuff. These analyst expectations. Of course they were higher than analyst expectation. I have lots of evidence to suggest that so-called analysts, by the way, we're talking about sell-side analysts, analysts at investment brokerage firms, at investment banking firms. Studies have shown that these sell-side analysts, they spend approximately 85% of their time in selling, and only 15% of their time in doing research. There's been studies that have shown that. So I don't know if it's even proper to call them analysts. But, of course, they regularly will have estimates that are lower than what I would argue they probably think is realistic. And why? Because they know, their firms know that, hey, if the company performs better than those estimates, the stock's going to move higher. This is so ridiculous. But it's interesting. What Tesla did not mention in that press release was anything else regarding the recent operating activities. And what I'm really getting at is they didn't mention anything regarding their expectations for earnings, for profits. And think about that for a moment. Well, if Tesla, they know what's going on internally when they put out these press releases about their deliveries of automobiles or sales. Well, don't you think they probably also know what their costs were over that period of time? And really not their costs, from an accounting perspective. The proper term would be their expenses, their expired costs. Well, they know, of course they know. And so therefore, don't they know what profits or losses they likely generated during that same period of time? Well, of course they do. Well, if their internal figures were showing that they were going to make a profit, or that their losses were going to be lower, wouldn't they have also told us that? Of course they would have told us that. So, I'm quite certain that, in fact, there's no doubt in my mind that they're continuing to lose money. And so why in the world would anyone pay $300? That's where Tesla is right now. $300 a share for a company stock who loses money month after month, quarter after quarter, year after year. And my research indicates there's a good chance they're never going to make a profit because it's a story stock. People believe in it. Well, beliefs will get you in trouble. Now, having said that, but now we're going to look at the other side of the equation. The fact of the matter is, once again, we have this herd of believers coming against us, that is buying the stock, bidding up the stock price, and we're standing here, or I'm sitting here, thinking that the stock is way overpriced and eventually it's going to fall sharply. Well, most of us, and I at least, don't live in the eventual world. I mean, when is eventual? Is that a year from now, 2 years from now? I don't know. And the reason I say that is now I got to start managing our risk here. We're already down 35% in the stock. And granted, it only accounts for 10% of our overall recommendations, our model portfolio holdings for a speculative portfolio, but still we don't want to let this go much further. So I'm monitoring Tesla closely for those of you that might also have sold short the stock, and I might come out at some point and tell you to cover your short position to minimize your losses, because we're just going to go sit here in this forever. And waiting for the rest of the world to realize what I think I know, and that is that I don't think Tesla's going to ever make a penny profit-wise, and that the stock is going to collapse. But when it's going to happen, I don't know. Okay, so I also bring that up for another reason. My gosh, I don't know if there are any exceptions to what I'm about to say. The vast majority of people, they're either money managers, whether they're hedge fund manager, mutual fund managers, any form of financial market money manager, or financial market so-called advisors. I'm talking about stockbrokers. They're not necessarily just stockbrokers, but they're people who get paid by these big wealth management firms to bring in money. not to give people good advice, and not that some of them don't give good advice. Of course, some of them give good advice, but that's not what they get paid to do. So their focus is never on giving you the best advice possible and managing your portfolio. Their focus is in bringing in new clients, bringing in new money. That's how they get paid. And once again, look, there are some good ones and some very good financial advisors. That's what they call themselves at these investment brokerage firms. But a lot of them are also very, very bad. And hopefully, if you use a financial advisor at an investment brokerage firm, well, hopefully you have a good one, and hopefully you have one that you can trust. And if that's good and they give you good advice, that's fantastic. My gosh, you're not going to just listen to me. You should never just listen to one person. You should listen to several different people that operate in this industry. But so I'll bring that all out to say, when it comes to those people who put out investment newsletters, as well as financial advisors at investment brokerage firms and money managers, you almost never hear them talk about their losing positions. In fact, they want to sweep them under the table. And that's not what I'm about. We're going to lose money on some of my recommendations. I'm not going to get everything right. And so I have no problem in also talking about our losers and how we want to manage the risk and limit our losers. Okay, enough about that. Let's move on to a different topic, and that is this health care bill. Well, the Congress is supposedly, the congressional Republicans I'm talking about, still debating the health care bill, or, still debating and trying to come up with a bill to repeal and replace Obamacare. The Patient Protection and Affordable Care Act is the technical name of it. And supposedly, they're getting closer to agreeing on a bill. Well, I don't have a clue. That would be a good thing. I discussed some consequences of Obamacare in our latest monthly journal, and I understand now. I did not before I did my research for that particular monthly journal, but I understand now why President Trump and many others have said that Obamacare is going to implode. It's not going to last. And I don't need to rehash that. I've already told you about what I uncovered. I don't like to use but all of us do that on occasion. Okay, separately, President Trump said a couple of weeks ago, but he's not going to just, now he's going to turn his focus to other areas. His proposals to reduce income tax rates, and his proposals to increase infrastructure spending, and his proposals to reduce government regulations. And today he gave a short speech on subjects that have to do with infrastructure building and government regulations, or they're related. And he put up a chart. Some of you probably already know this, about how sometimes it takes up to 20 years to get approved to build a road, and how that's just got to end, and how he's planning on coming out with certain executive actions or proposals for Congress to make sure that it ends, so that we can speed up the building of any type of infrastructure project. He already had an executive order that he issued about 2 months ago that is also related to that topic. But he also mentioned in that brief speech that indirectly, very indirectly, but indirectly suggested that he might propose up to or even more than $1 trillion spending on infrastructure projects. Now, he did not say government spending through taxes. And my guess is his proposal is going to have, it's going to have a lot to do with state government spending and incentives for construction companies, from infrastructure building companies. Not that all this money is going to come from the federal government and therefore from you and I in taxes. But and it doesn't surprise me, his timing in this. And I was thinking just a couple of weeks ago when the Republicans' first attempt to repeal and replace Obamacare did not, was withdrawn, and Trump said he was going to turn his attention to other matters, even though he would also continue to fight for the passage of a new health care bill. I was thinking at that time, I was thinking, my guess is probably within the next 2.5 weeks, we're going to have an announcement from Trump that's going to mention infrastructure. And the reason I bring that up, my thinking was, boy, some of these infrastructure stocks that I recommended over the past few months, they pulled back substantially over the past, it's been about 6 weeks now, since late February or the beginning of March. So, 4 to 5 weeks. And, as I've said before, boy, I beat myself up for not just getting out of some of those positions, taking gains and waiting and going back in. But that's all in the past. You can't change the past. But my opinion has not changed longer term on all of the infrastructure stocks that I've recommended. And I've been monitoring them very closely. And I went in and did some personal buying Cliffs Natural Resources just a few days ago, and it's kind of trading sideways. But, as I put out in a very, very brief market alert recommendation, what's it been, about a week ago, that I was essentially recommending to you, our subscribers, if you had some extra money in sideline, that I think you should add to those infrastructure positions. Speaking about Caterpillar, Vulcan Materials, Cliffs Natural Resources, and Granite Construction, as well as our steel recommendation, the steel ETF, and our copper ETN, symbol is JJC. And I continue to think that's true. Now, we had another helpful comment or announcement or put out today regarding one of those infrastructure-related companies. That's Caterpillar. Goldman Sachs issued a research note stating that they had added Caterpillar to their, quote, conviction buy list. You think about that. Wouldn't anything that you buy, wouldn't you have a conviction behind it? But no, whatever. We don't need to get distracted here. I just find that kind of funny, their conviction buy list. I guess they feel really good about that. And that's what they mean. Well, when they feel good about anything that they recommend buying? Anyway, once again, let's move forward. And they put on that a target price of $120 for Caterpillar. That's where supposedly they expect the price to go. They never tell you the period of time. Does that mean a month from now, 2 weeks from now, 3 years from now? They don't tell you that, which I also find funny, because I'm sure Caterpillar someday will be the stock $120, but if it's 10 years from now, it's not going to help as much. But that's 30% higher than where it closed on Monday of this week, that $120 price. And what's important about it, and why I'm telling you about it, is it doesn't mean that Goldman Sachs is going to turn out to be correct about Caterpillar, nor that I'm going to turn out to be correct about Caterpillar. But what it does mean is now we've got some institutional support. In other words, we have Goldman Sachs out here through their thousands of financial advisors recommending that their clients buy Caterpillar. And that's going to likely help put some push behind the stock, as well as our other infrastructure-related stocks. So that's a positive thing for us and those of you that hold any of those infrastructure stocks that I've recommended. Now, third topic. We're probably already 20 minutes into this. I think we're about going to be maybe 10 more minutes at the most. Hope I'm not boring you. This is important stuff. For those of you that follow my fixed income portfolio recommendations, as I mentioned in our monthly investment journal, we still have 20% of that portfolio allocated to cash. So, and hopefully you have some extra money to invest in securities that you usually invest in for income generating purposes. And if you do, as I said, there's a good chance that I'm going to recommend that you, our clients and subscribers, at least those of you who follow our fixed income portfolio, to allocate some of your money to Host Hotels and Resorts. That's HST. LaSalle Hotel Properties, symbols LHO, and Ryman Hospitality Properties, symbols RHP. And I'm going to look right now, let's see, pull up the right model portfolio here. Sorry for the delay. What I'm doing too is I'm going to my live trading screen here to take a glance at those securities. I took a glance earlier today, and each of those securities since, let's see if this is true for all of them. Well, LHO, LaSalle Properties, is traded mostly sideways since December with a slight downward bias. Host Hotels and Resorts, wow, that's almost just no downward or upward bias. Sideways trading range since December. And Ryman Hospitality Trust, a little more volatile than the other two, but essentially also a sideways trading range since December of last year. And so, today, as they're trading all of those stocks, well, that's not true, but at least Host Hospitalities, Host Hotels, that is, Host Hotels and Resorts, and Ryman Hospitality, trading near some key price support levels. So, if you do have some extra money sitting on the sidelines and you would, looking to add to some fixed income securities, there's a good chance that I'm going to advise you, our clients and subscribers, to put some of your money in those, at least one, if not all three of those stocks over the next few days. So make sure you check your email, usually around 7 o'clock in the evening every day, between 7 and 8. I know it's a little late for some people, as well as before the financial markets open for trading, for a potential trade alert. Very, very good chance that I'm going to recommend putting some money in one or all three of those stocks, at least within the next week. Let's try to push forward a little faster now, as well as our back to our speculative portfolio recommendations, as well as our growth and income portfolio. And if you haven't noticed, what I tend to do with the growth and income portfolio is I'll have some stocks and ETFs, ETNs in that portfolio that also are in our fixed income portfolio. There's the income part. And I'll tend to have some of the same securities in our growth and income portfolio that I also have in our speculative portfolio, the growth part of it. Not just, when I say speculative, a lot of people associate the word speculative with risk. Well, my gosh, I don't like to take risk. I manage my risk. That doesn't mean, it means you're speculating on the future direction of the price of the security as opposed to generating income. So, I as I mentioned in our monthly, I'm monitoring closely several speculative securities too, growth type stocks, Alarm.com, Athena Health, Barracuda Networks. I'm not going to go through them all. You can go to the monthly journal and I listed them there, but I'm monitoring those securities closely. I'm waiting to try to get in, at the right reward to risk time and at the sensible valuations. Let's see. Now, two other topics, and then we're going to wrap this up. I'm contemplating coming out with an additional service that I think some of you might be interested in. And first of all, look, most people that are in the business that I'm in, or similar businesses, especially the financial market newsletter writers, the vast majority of them, not all of them, they always have numerous publications. There's this news service. They have 3, 5, 10 different services. The reality situation is, because they want to keep selling, they want to keep making money. They want to, there's nothing wrong with making money, but they want to always have more money for themselves bringing in. And I would argue, at least looking at their performance records from the recommendations, I don't know how interested they are in looking out for their clients and their subscribers, but they seem to be more interested in themselves. Let's put it like that. And I'm trying. Of course, I want and need to make money, and of course, I'm interested in myself. But I also truly want to take care of our clients and subscribers. So I'm thinking about coming out with another for a short-term trading service. And if I do, for those of you that are subscribers to Frazier Strategic Allocator, well, I'm not going to charge you several hundreds of dollars or over $1,000 like some of these services do. If you're already subscribers to Frazier Strategic Allocator, I'm going to keep the price really low. And in fact, I'll let you help me to decide what is a proper price if you have an interest. So, this is something that I had done from mid-2011 to February 2015. I had a short-term trading service, and I stopped doing it because it just didn't make a lot of money off. It didn't have a big client base. Literally never really focused on growing the client base, and primarily because at least during early 2015, I decided to start focusing much more of my time and focus much more of my time and attention at that time on our hedge fund business, our hedge fund research and advisory service. But when I go back and look at the performance record of that short-term trading service from mid-2011 to February 2015, I only made 47 stock recommendations during that period of time. I mean, you're talking about during 12, 30, 3.5 years, only 47 recommendations. Once again, it wasn't my focus. I didn't devote a lot of time to that service. And also, I'm not a person in short-term trading. I don't try to do a trade every day or every week. Once again, I use the Ted Williams approach. Ted Williams, tremendous baseball player from the 1940s to the early 60s, I think, is when he stopped playing. Might have been late 60s, not sure. Hopefully, you're familiar with Ted Williams. I wait for the right time, what appears to be the best reward to risk time, or I don't, I just don't do any short-term trading. So sometimes I don't do a short-term trade for weeks. I'm just waiting for the right time. But so that's also a reason there were only 47 recommendations in a period of 3.5 years. But out of those 47 recommendations, 40 of them made money. That is 85% of those recommendations made money. And the vast majority of those stocks that I recommended, the overwhelming majority, were held between about 3 days and 25 days. And I don't want to dwell on this, but it's just something else that I'm thinking about coming out with, because I'm thinking our subscribers might be interested in such a service. So not trying to sell you on it, just mention it to see if you might have an interest. And if you do have an interest, please send us an email. In fact, send it to me directly. Send it to David, my name, at Frazier, Frazier, you should know how to spell it, and Mayer, the word and, A-N-D, Mayer, MAYER.com. David at Frazier and Mayer Research. David at Frazier and Mayer.com. Send me an email directly if you think you might have an interest. And if enough of you do have an interest, then I might come out with such a service. And also tell me what you think a proper price would be if you have an interest. Okay, enough about that. Lastly, continuing to make improvements to our internet website, investorsmonitor.com, and still don't have everything exactly the way that I wanted, but we're darn close. And I try to update this site every day, but I need to focus on this service and try to help you to make money and to manage your risk. So there's only so much time in the day. But one of the things that I did recently is, and I plan to keep doing, is every morning I on the homepage of that website I put just a short paragraph on what my research indicates is going to happen during that particular day and during over the course of a few days. So I encourage you to go there at investorsmonitor.com. Well, that was a lot. That was probably a half an hour instead of 20 minutes, and it might have been longer than that. I hope not, but I hope you got something out of this. I thank you for listening and watching, and once again, send me an email if you think you might have an interest in a short-term trading service, and feel free to send me an email at any time. Let me know if you think I'm doing a good job, or if you have some complaints, or if you'd like for me to cover other topics. I want to know. So let's wrap it up. Thank you for watching and listening, and I'll talk to you again next week.